This idea of ownership is super important to understanding the difference between an operating and a capital lease and even affects how each is recognized on the books. With a capital lease, transfer of ownership to the lessee is the key criteria to determining whether or not the lease is a capital or operating lease. In addition, what we call the risks and benefits in the accounting biz are transferred to the lessee, meaning that the lessee will have to pay for stuff like taxes, maintenance, and insurance. Capital lease is considered an asset, so it will show up on the balance sheet. From a tax perspective, this all allows the lessee to claim things like depreciation on the asset itself. This is all different with an operating lease because ownership is retained by the lessor. The risks and benefits stay with the lessor. Because of this, payments are considered an operating expense and so show up on the profit and loss statement. For tax purposes, an operating lease is considered a rental expense. So, to break it down a little further, a capital lease records interest expense, keeps the originally booked asset and value on the books, does not record lease expense, while an operating lease reduces the value of the asset on the books, the right-of-use asset, records lease expense, does not record interest expense. Let's hear from an expert with some advice about the differences between operating and capital leases.
So capital versus operating leases. So 99 times out of 100, when we look at leases, typically with a small business, it's almost always an operating lease. This is going to be for a copier almost all the time, it feels like. And when they pay that lease, it is listed as an expense. 100% of that payment would go to a lease expense typically. Now, when we think of an organization having a larger piece of equipment, a bulldozer or whatever the case might be, where they're using it in the operations of their business, it could very well be a capital lease. With a capital lease, we're going to list that as an asset on the books. And it's almost like having a loan because the entire payment on that lease is not going to a lease expense. We would, in fact, need to break that up as interest expense on that payment. And that's the piece that would be expensed. But it is important to note that that can vary depending on the actual lease agreement. So typically what I would see with most bookkeepers is you might have a copy of that lease. You might read that lease and get your idea of what you think it is. But typically we are going to refer to the accountant and ask them exactly, what needs to be done. And then we would actually book that transaction according to how they direct us to do that. Again, always recommend reading that and having some idea and learning through that process. But typically we'll work with that accountant to decide how that's going to be recorded. And then going forward, we would record the payments as needed, whether it's a capital lease and we expense part of that as interest, or if it's going to be an operating lease where 100% of that payment would be listed as a lease expense.